Okay. So good morning, everyone. So welcome for this very important Global Udan webinar series, the 18th in a row, which is there today. So the very important topic, which is decided for this Global Udan webinar series, setting up Indian subsidiaries, compliance and reporting requirements. So thank you all of you for joining. Special thanks to Prashantji, taking very important discussions, excellent speaker with his sound knowledge. I'm sure there'll be a lot of interaction, discussions, question will be asked, and I'm sure Prashantji will be able to respond to maximum in a given time, able to respond to the queries, but definitely whatever questions received from the participants will be shared with Prashantji and will be able to receive quick response in quick time. So once again, welcome Prashantji. Welcome, Suraj, for with your sound knowledge, experience, taking over as a moderator for this very important discussions today. And welcome all the participants. As always, a participants' response is a big support to this Global Udan webinar series. Just to say that through the series, our mission remains steadfast. It's more important for us to empower the Indian chartered accountants to explore global professional opportunities. And that is where, our focus is from this directorate to enhance the knowledge, strengthen their ability to operate in an increasingly interconnected business world. So that's what this reason of having this important topic, setting up Indian subsidiaries, compliance and reporting requirements. And I'm sure with the practical importance, this topic will be immensely responded by the participants. With India being emerging as one of the fastest growing economy, it attracts a lot of foreign businesses keen to establish their footprint here. So I'm sure understanding the legal framework, the compliance obligations, the reporting requirement certainly would be very essentials, not only for the foreign investors, but also for the Indian professionals who are advising these foreign investors to come and have a setup in India. So this session definitely help the participants with clarity on incorporation process, statutory compliances, best practices to ensure smooth business operations. So just to share some of the important initiatives, recent ones, and the upcoming initiatives from the Directorate, the GCC Summit. We had an excellent summit in the month of June, which was 27th, 28th of June. Excellent response received. Now again, we have a GCC Summit at New Delhi, which was there on 27th, 28th. Now it's at Ahmedabad, Gift City on 29th and 30th of August with more planned and structured experts speaking on 29th and 30th August. I request the participants to please register, if not till today. We've already touched 400 registration and we expect to have a couple of more or few more registrations and would be hoping to have again a great success for this event. And then next in line is Mumbai and Hyderabad, ensuring that India's position as a global accounting hub. The iTech training program already planned from 15th of September till 30th of September. It's a 2 weeks program for delegates, which is also from the Ministry of External Affairs. They conduct the capacity building programs for international delegates, which has already been planned in Center of Excellence. The certificate courses, after the success of US certificate course on outsourcing, the 9th batch completed. Now we are in a position to start the overseas outsourcing certificate course for UK. So this is the tentative date. The first batch already launched is on 8th of September till 17th of October. And I'm sure the members, participants would be keen to know, for those who have already done the US, would like to get into the UK outsourcing services also, or if not, certainly would like to know what are the opportunities which are available for the UK's outsourcing services. This Global Udan series again is very important, and I'm sure with the experts like Prashantji, an eminent authority in corporate law and cross-border advisory services, he'll definitely share his invaluable insight into the nuance of setting up Indian subsidiaries. And also the moderator, Surajji, once again, thank you so much. With your expertise, will guide today's discussions towards practical takeaways for all the participants. And I'm sure the participants will be very encouraged to listen to you. And I once again thank all the participants because with your support, your participation, your encouragement, this global series would never be in a success. So once again, welcome all of you. And I'm sure we'll have next 2 hours a very happy learning and interaction for among all the participants from the experts. Thank you. Over to you, Surajit. Thank you.
Thank you. Thank you, Abhay sir. Good morning, everyone. Very warm welcome uh, to each of one of you. I hope you all are energized and ready for an engaging and insightful session today. The ICI Global Udan initiative is aimed at empowering chartered accountants and the business community with the knowledge, insight, and tools needed to navigate the ever evolving global business landscape. Sessions like these create a bridge between technical expertise and practical implementation, enabling us to serve our client and our organization better. Today's topic, setting up Indian subsidiaries, compliance and reporting requirement, is not just a procedural checklist, but a strategic roadmap for business entering India. It involves understanding legal framework, taxation norms, FEMA guidelines, and reporting protocols, areas where CAs can play a crucial role as trusted advisors. And guys, we are very honored to have CA Prashant Velanki with us, whose expertise will guide us through the nuances of the subject and provide valuable, actionable insight. So, I invite all participants to listen intently, take notes, and actively engage in the Q&A session that will follow. Now, I'll just introduce Prashant sir. Prashant is the founder and principal consultant at ProLead, a global financial and business consulting company, empowering entrepreneurs and businesses at a very growth stage in an increasingly complex global environment. ProLead's comprehensive business solutions span market entry, assurance, tax, and regulatory startup and corporate advisory services. Prashant leads their Indian and Singapore practices where he specializes in market entry and business structuring, attest services, process design, and control advisory for diverse entities. Prashant has facilitated the setup of Indian operations for global companies and serves as an independent director on boards for listed and unlisted companies. His blend of financial acumen, regulatory knowledge, and strategic insight drives client success across various industries and growth stages. So, in today's section, we are covering the topics like context and Indian opportunity, FDI framework and prerequisites, incorporation processes, RBI and Forex compliance, GST and international trade, ongoing compliance framework, financial reporting, and following Q&A for the procedures. So I welcome, once again, I welcome CA Prashant Velanki to take us through today's session.
Thank you, Suraj. Good morning, everyone. I'm really looking forward to the session. At the outset, I would like to thank Abhay sir and the entire team for conducting this series at the outset, right? So I'll thank them for having me here. That is one part of it, but I really want to appreciate the entire team for conducting this Global Udan series while I just pull up my slides. And the reason I say that is we are at a very crucial juncture as a country. I'll give you that context as part of my topic as well. But it is something that is very relevant for us as chartered accountants to be involved in this because we call ourselves partners in nation building. Right, and I'm glad that we're discussing this a day before our before we celebrate our Independence Day. Uh, I think we have gone through an incredible, fascinating journey as a nation. So we've have our regional aspirations, linguistic aspirations. If you go across the length and breadth of the country, we speak different languages, we eat different food, we at times we believe in different gods. But if there is one thing across the length and breadth of the country that unites us, that's our love for the nation and the pride that we all carry as Indians, right? And India right now is placed in a very crucial juncture where we have as a country the opportunity to lead the world, right? And when we as a community, as chartered accountants, talk about our role in nation building, it is extremely critical for us to contribute towards that nation building at this juncture. Now, it could be about helping Indian businesses that are going global, or it could be about opening up India as an avenue for foreign companies coming into India. Our role is very critical. Hence, I'll really appreciate Abhay sir and the entire team for this Global Udan series where they're making us as a community, as professionals, relevant in this juncture, right? Where we can be partners in nation building. So, with that context, I think I'll walk through the agenda today. While Suraj and Abhay sir has given a context in terms of what we're going to discuss, but typically what we'll do first is we'll understand the context in terms of where we are, why India is a very crucial destination from a global perspective, why foreign companies are looking at India at this juncture, and then we'll walk through what are the FDI related aspects. We've relaxed a lot of these FDI aspects in the recent past, so we'll discuss that, and then we'll get into the practical aspects of setting up. If a foreign company is interested in setting up in India, it could be a subsidiary, or I'll also touch upon some of the other aspects like a project office, license office, but I'll focus more on 100% subsidiaries. So, what is it that we can do as chartered accountants? How do we guide them through this entire journey of India entry? And then we'll also talk about the ongoing compliance. And like Suraj said, towards the end, we'll take up questions around these topics. So, at the outset, why India? Again, I think over the years, India has become a very important destination for a lot of global companies. Now, the reason why it is an important destination, those reasons have changed. Initially, they were looking at India as more of a development center. Outsourcing teams were set up here, offshoring teams were set up here. But in the last 10 years, especially, we are also seeing India is looked upon as a good market for their products and services. So we've seen that shift happening, right? So where India was more of a, I'll set up a development center here, I'll set up a software captive cost center for development or research, or could be for business processes, KPOs, etc. From that, we are now in an era where foreign companies are looking at India as a good market for them, right? And what are the factors for it? Why India the compelling case? Again, all the esteemed members are aware, and we're all happy that we are now the fourth largest economy, and I'm hoping very soon we'll also overtake Germany and will become third. Long way to go in terms of let's say per capita numbers, but this is a great progress, right? And what while we are focusing on we growing into the fourth largest economy, one of the crucial aspect which we need to emphasize on is the consistency in our growth rate. No other major economy in the world has been able to grow at 6 or 7% consistently over the years. And if you look at our Indian CAGR, we are looking at more than 6% over the last 10 years, which no other major economy has been able to do. The global average is about 3%, 2.83%, right? So it's not just the absolute numbers, it's the rate at which we are growing that makes us very attractive for a lot of foreign companies. And the other thing, again, this is very relevant for companies which are looking at India as a market, or it could be India as a talent pool, the median age. So again, in terms of our demographic advantage, we have a huge advantage with a relatively younger population in India compared to other economies. So these are some of the factors which make India very relevant. If you look at under 35 years of age, we have 700 million people in India alone. That's a huge number. That's about 70 crores population under 35. Working population growing by about 1 crore every year, right? Most of the population, again, English speaking population, right? So, and more importantly, especially in the last one and a half decade, I think 2010 onwards, the kind of digital acceleration that we've seen, right? That is again something that will make us very attractive for any global business looking at entering India. Now, I've already spoken about the rationale behind setting up in India has progressed more towards looking at India as a market along with all other factors. So those factors of cost arbitrage, those factors of talent pool, English speaking population, all of that exists. But there's a new factor that got added, and that is our consumer market. Our consumer market currently is about $1.2 trillion dollars, and it is expected to hit $2 trillion dollars in the next 5 years. The expansion of our middle class, again, we're having about 500 million of our population by 2030 is the expectation. So what happens is with this, the middle class with disposable incomes going up, a lot of foreign companies are also looking at India as a very important market for them, which was not the case a few years earlier. Again, urban consumption is growing rapidly, and then your per capita income growth also we've seen. So, like I said earlier, it's not just the growth in absolute numbers. It's in the growth rates that we are seeing consistently over the years. That is what makes India very relevant for global companies. So it's like, if you're a global company, I cannot afford to miss the Indian opportunity. If I want to stay relevant in the global world for, let's say, 20 years, 30 years in the future, you could be sitting in the US, you could be sitting in the Europe or anywhere in the world. But if you want to be relevant for the next 20, 30 years as a foreign or a global company, you cannot miss the Indian opportunity. And that is sort of reflecting in our FDI performance as well. We've seen record breaking numbers over the years, significant FDI inflows coming into our country. If you look at the top sectors, I think ITES still remain the top sector in terms of where we are getting our FDI numbers from. Services sector, computer, software, and hardware remains the highest, and then followed by telecom, trading, and automobile industry. And again, country-wise FDI sources: Singapore, Mauritius, USA. So I think Singapore and Mauritius is more from a structuring perspective. You have a lot of businesses with their holding companies in Singapore and Mauritius. They setting up their subsidiaries in India, and then followed by US. Netherlands is again from a structuring perspective, and then you have Japanese investments as well. So this is in terms of country-wise FDI metrics. Now, this is something that we as members will really need to focus on, post-COVID growth acceleration. In fact, a lot of people worried how would this whole globalization pan out with COVID coming in. While 2020, there were a lot of doubts with respect to what is going to happen, and how are we going to cope up with this pandemic, etc. But then 2021, we've seen great numbers. So the recovery was very rapid, and we've seen great interest in India. Why? Because even some of those traditional businesses which believed remote work, offshoring, outsourcing may not work, all of those doubts were dispelled during the COVID time, right? So 2020, where companies were forced to remote working, hybrid working. So those companies which were hitherto resisting that, now that's the new reality, right? So hence, post COVID, we've seen a great amount of influx with respect to GCCs, GDCs, STCs being set up in our country, because now a lot of companies have opened up to that possibility, saying, yes, now we can do our work, in fact, in a better way, in a more cost efficient manner, with hybrid or remote working. Hence, that opened up avenues for us as a nation, where we were looking at a lot of companies setting up their captive cost centers, service delivery centers, developments, global development centers, capability centers across different locations in the country. So we've seen a good amount of acceleration post COVID. Things are a little slow, I would say, in the last 1 year or so, or maybe I think extended to the last couple of years, thanks to the geopolitical reasons, and then uncertainty with the whole tariff and trade wars that are happening. But I think this is a minor blip, right? So eventually, like I said, the new reality is that in the globalized world, you can't say, I will remain only in this market paying a higher cost when there's an alternative in another nation at a lower cost. No company can afford to do that. So hence I say that for a global company, India is an opportunity that they cannot miss. So if you look at some of the numbers, specifically in terms of foreign subsidiaries, we've had about 2,400 new foreign subsidiary registrations in the last couple of years. Then average setup time has reduced thanks to the new portals, some of the digitization initiatives that we have taken up. The setup time in terms of setting up your subsidiaries by foreign companies, the setup time has reduced. And obviously now there is more, in terms of process understanding, there are more professionals getting into it, right? And hence the success rate with respect to the applications has also gone up. One is because of the simplified processes. Second, there's also more influx of professionals coming in, taking this up as an avenue. The success rate of those applications has gone up. So this is on the subsidiary registrations in general. But again, one other important factor, especially those who are into manufacturing, is again PLI scheme, which the government has been very proactively pushing through across different sectors, where we're targeting additional production in the next 5 years. We're expecting that about 60 lakhs of direct and indirect jobs will be created just as a result of this PLI scheme, right? Now, in addition to all of that, again, there are multiple schemes and initiatives that are taken in terms of how do we simplify the processes. Having said that, I'm not here to vouch that everything is perfect. There's a long way to go in terms of further simplification, single window systems, etc. But compared to where we were, let's say 10 years ago or 15 years ago, to where we are now, There's a significant improvement in terms of ease of doing as well. In fact, the World Bank somehow, for various reasons, suspended this whole ease of doing ranking a few years ago. But we were making rapid progress. From about 142, we've gone to the 60s. And if that ranking had continued, I'm hoping, or I would assume that we would be somewhere in the top 30 countries as far as ease of doing business is concerned. So yes, there's a lot of work that has gone into making India an attractive investment decision, where India could be a potential, business destination, right? And specifically focusing on GCC and GDC. In terms of capability center, development center, like I mentioned in the initial slides, there's a huge potential because of technology adoption, because of English speaking population, right? And availability of skilled workforce across sectors, right? Technology to any sector, you name it, we have availability of that skilled workforce. Hence, for GCC, GDC, India is the growth engine, right? And we're looking at about, as on date, we have about 1,700 plus operational GCCs in the country. We are looking at close to 55, 60 lakh people employed in these GCCs, GDCs, contributing an annual revenue of over $64 billion. And the growth rate, if we were to look at it, is about 15 to 18% as far as GCCs and GDCs are concerned. So a lot of countries are now looking at India from this perspective as well. It's been there for some time, but it's just got accelerated post COVID. Now, with that, I think I'll want to set the context also in terms of, if I'm a global company, if I'm looking to enter India, what are the various structures or options that are available to me? So again, we have branch office, project office, liaison office, and wholly owned subsidiary. Then within the wholly owned subsidiaries, again, you have, or within subsidiaries rather, you have different structures, wholly owned, or you have an Indian partner that you've partnered with, etc. So I'll not get into that. I'll just focus on, let's say, when I'm a foreign company, I'm looking at entering India. What are the immediate options that I have? Now, branch office is a fairly simple, it's an extension of my legal entity outside India. So, which means to say, I already have an entity outside India. Now, I'm not creating another entity in India. I'm not creating a new company in India, but I'm just extending my operations to India. Now, what are the challenges here? Again, so in India also you're a foreign company. So it is not a very efficient structure from a taxation perspective because you're treated as a foreign company here. You're allowed to import, export, all of that. But again, there are certain activities which are prohibited. For example, retail is something that you cannot get into, agri is not something that you can get into, etc. But more importantly, this is something where you just want to try it out for a short term. That is when you look at branch office. But if you have long term objectives of entering India, then branch office may not be the ideal structure that you will need to look at. Similarly, project office is again, you won a particular project. It could be in the private sector or the public sector with the government, and to implement that project, you need to have presence in India for a short period of time. So it could be a couple of years where there's an infrastructure project that has come up. You need to execute that infrastructure project 2 years, 3 years, 4 years. Then you set up a project office. Again, you're allowed to do only those activities which are in relation to that specific project for which you have taken RBI approval. Right. So that's a project office. So again, this is an extension of your foreign operations. You're not creating a new entity here in India. Liaison office is something that is even one step lower in terms of what you can do. Essentially, you cannot carry out any form of trade, that is buying, selling, etc. Rather, this is more limited to understanding the Indian market through a market research, right? It is essentially acting as a liaison between the parent company and the Indian market. So only then you go for a liaison office. Again, like I articulated earlier, you're not allowed to do any commercial or trading activities when you're a liaison office. So you can only be a captive center to your parent company, where you're very clearly given an objective of carrying out a research or something to do with an Indian market. You're not essentially selling anything on their behalf. The sales happen from somewhere else. So you're essentially gathering information about India, etc. So that is when you open a liaison office. Now, when does liaison office make sense? Liaison office typically makes sense where I want to test the waters. I have grand plans for India, but then I'm not very sure if I should go all in at this stage. So I want to test the water. So I'll deploy a small team who will do a research, who will get me clarity with respect to what my entry strategy should be. So that is when you can get into a liaison office, and then at a later stage, move to a wholly owned subsidiary. So these are the three options, and then now we'll come to subsidiaries. When I say subsidiary, yes, wholly owned subsidiaries is where you have 100% of the shareholding in the Indian entity resting with the foreign body corporate. So why is this recommended? Typically, because obviously from a risk management perspective, you have Indian entity being separate, the compliance risk can easily be managed and addressed. Uh, there is more scope with respect to what you can do through the entity. There are a lot of restrictions when you're talking about a branch office, project office, or liaison office. Whereas when you're looking at a wholly owned subsidiary, those restrictions do not exist except for the FDI sectoral caps. You do not really look at any restriction as far as activities are concerned. The Indian entity can raise local funds. You can issue ESOPs to your Indian employees specifically from the Indian entity. You can enter into partnerships with your other business and trade partners. So that is again all these are all the advantages of the Indian entity. Access to tax treaties because the Indian entity itself will be a tax resident of India. Hence, you'll have certain advantages from taxation and tax structure perspective. So that's wholly owned subsidiary. So the moment any company is looking at long-term operations or scalable operations with a flexible business model, right? Then wholly owned subsidiary is what we recommend. That wholly owned can be any form of subsidiary. So when does it become a subsidiary? The moment I have control over more than 50% of the shares in the Indian entity as a foreign body corporate, the Indian entity becomes my subsidiary. Now, who owns the other shares? Do I own it fully 100% or do I keep it at 80 and give 20 to an Indian partner who I would want to incentivize? All of that is up to me, right? As a foreign player for me to decide. So in today's discussion, let us focus more on subsidiaries of foreign companies. How do we set them up? And then what are the compliance? What is the compliance that is involved for these subsidiaries? This is something that we as members, as professionals, need to very clearly understand that when we are advising clients, foreign clients, especially when they're entering India, it is important to understand and make them aware of the importance of the business model. A lot of times we get into the legalities of it first in terms of creating a structure, creating a subsidiary. These are the documents that I'll need. But before that, it's extremely critical for us to understand what is the objective of setting up in India. So, what is the business model of the Indian entity? Now, are they looking at India as a sales and marketing hub, which is more high risk? The Indian entity will now face customers, etc. Is it that? Are they looking at Indian entity being a development center for them? It could be engineering services or it could be any other research or development, right? So that's a different business model altogether. Are they looking at some sort of shared services? It could be in the areas of finance, legal, admin, HR, etc. So that is where a lot of your GCCs and shared services will come in. Shared services where they're looking at India providing that support, right, in one of these functions to various entities around the globe for that particular group. So that could be another option. Or are they looking at a hybrid model where they want Indian entity to perform a multifunctional role, where the Indian entity will also sell their products or services in India. The Indian entity will also be a shared services hub for some of their global operations. So we as professionals will need to understand this first and then curate our entire proposal accordingly. Because a lot of times it's not that one size fits all, especially the business model, the choice of business model will fundamentally change their transfer pricing compliance requirement, their tax optimization opportunities, right? Hence, it's extremely important for us to understand this even as professionals. For example, what are some of the licenses that we suggest for them? Do we ask them to set up in an SEZ or a non-SEZ, right? So all of this will depend on we understanding their business model very clearly. And again, at this stage, it is also important that we as professionals lay out the entire plan for them, understand their business objects, and lay out the entire plan for them with respect to how they can grow in India. It's not just about entering India, right? Once we understand their business objective, let's say they are into they're looking at India as a market. Then we also need to be able to give them a roadmap saying this is where you start off, and in the next 5-10 years, this is how you expand in the country. Or if they're looking at India as a development center, then again we say that this is the most optimal structure to start off, and this is how we scale it up to a level where maybe you're starting off with a 20 people or a 30 people development center in the country, but you have plans of making it a 4,000 employee, 5,000 employee development center. How do we as a consultant, or how do we help them grow in that particular manner, right? The plan that they have. So it is very important for us to take them through this entire journey, not just at the initiation but also through the various stages of scale up and growth. And the last thing is also a consideration for foreign companies when they're entering India. What happens when I need to exit, or if for whatever reason I choose to exit? So that is something that again we'll need to discuss with them, give them various exit options, right? Repatriation options also play an important role when we are understanding business model. So this is really the first stage. In my experience, what I've seen is, like I said, we jump the gun and directly go into entity incorporation a lot of stages. But it is very important that we prepare the client saying, if we do the planning phase correctly, where we are understanding the business model, we are laying down the structure for them, the growth path for them, and then get into the incorporation stage. It really helps both the parties, us as professionals as well as businesses, because that brings in more clarity. The expectations are also clear. And as members of professionals, I think this is something that I'll want to put it out right. Yes, we'll have clients coming in and saying that on that website, I've seen this professional says it takes only 1 week to incorporate in India. Why are you telling me 2 months, 3 months? Please set the expectations right at day one. There'll always be people who will say that it's a 2 day thing, it's a 3 day thing. You can sit somewhere somewhere outside India, pay through credit card, your entity is set up. There'll always be people like that. But as professionals, it is very important for us to make the client aware of what is the value add that you are bringing in. Why are you justifying this 2 month, 3 month period? Because if we spend that 2 month, 3 month period, the incorporation will be as per the existing laws, fully compliant with the existing laws from all aspects. I don't want to comment on some of these websites where they say Indian incorporation in 1 day, you'll get your business set up in 2 days, 3 days, and all of that. I don't know how they're doing, but as far as I'm concerned, if we were to sit with the client, understand their business objects, ensure that they're compliant with Companies Act, ensure that they're compliant with FEMA and every other regulation around, you buy that time from the client saying it is a 2 to 3 month journey where we'll work with you very closely, understand your objectives, understand your business model, and then take you through the entire journey. And in some cases, I'll talk about those cases, it is in fact longer than 2 to 3 months as well. Right. So that's on understanding the business model. Now, coming to FDI norms and sectoral analysis, I remember when we started doing this about, I think, 10, 12 years ago, every time we had to open that document and see what are the sectors, what are the sectoral cap. Now it's become super easy. And why do I say that? Because most of our sectoral restrictions are now liberalized, where automatic route is almost the default. So the default one is when we are advising clients, most sectors, the default is 100% FDI, automatic route and approval route. Now, what is automatic and approval route? Automatic route is when you just incorporate, you get the funding as well, and then you file your forms with RBI through the authorized dealer. So that is through your banks, right? So that's an automatic route. Approval route is where you will need to take a prior approval from the government and only then you can incorporate. So back in the day, there were a lot of sectors which were under approval route, or above a particular threshold, it was under approval route. Now, most of the sectors that we deal with, especially if you're talking about GCCs, GDCs, IT, ITES, these sectors mostly are all under 100% automatic route, which means to say you can go ahead, incorporate, and then you file the forms for from a FEMA compliance, RBI compliance perspective with the banker. So that's automatic route. So what are the sectors that are still under government approval route? Defense, obviously, and then you have insurance. Multi-brand retail is again something that is that comes with sectoral restrictions. Print media, FM, etc. So these are some of the industries that are under the approval route. Rest or all liberalized. There are some prohibited sectors, obviously, from our sovereignty perspective. We've ensured that certain sectors there is no foreign investment. Again, railway operations. There are some areas of railways where the government is liberalizing, but broadly railway operations, atomic energy, gambling and betting. We've seen the controversy with some of these Chinese investment coming into our gambling and betting apps a few years ago when the government had to impose a ban on all of these, right? So gambling and betting again is prohibited sector. Real estate, again, there are areas of real estate, let's say land holding, that is not allowed. Whereas you can be into development, but only from a holding of land perspective, there are restrictions. So these are some of the prohibited sector. But I think broadly the trend is in terms of liberalizing as many sectors as possible, opening up where there's a business opportunity, let foreign players come in with their technological expertise, collaborate with us, we can bring in cost efficiency. So the government is also looking at it from that perspective. Hence, a lot of FDI norms are liberalized. And then, like I said, while most sectors are liberalized, there are certain sectors where an approval is needed. Where an approval is needed, then what is the journey? Again, we'll need to carry out a pre-application assessment where we'll assess what are the sectoral caps, what is the process with respect to you filing the application, getting that approval from the government. There are certain sectors where which are under that concurrent list where we'll also need the local state government approval as well for foreign investment to come in. But again, the good thing in the last few years is that states are actually competing with each other to invite foreign investors. So from that perspective, it is again not how it was, let's say, a couple of decades earlier. Now the states are also very proactive. Each and every state, most of the states in the country have their own investment promotion boards. So the moment there's any foreign investor interested, again, we can connect them with the respective state foreign investment boards. A lot of state-specific licenses are liberalized there. So all of this is again pre-application and planning in terms of how you'll approach it. Then the approval itself is through this portal on foreign investment facilitation portal under FIPB, and then there is an interministerial consultation. So all of this process will need to factor in about 4 to 6 months. Because again, depends on the sector that you are in. Let's say media. In the recent past, any media related approvals for foreign players to come in for the right reasons. Again, the government is very particular about the documentation involved, who ultimately owns this media house, etc., etc. So it takes time, but a minimum of 4 to 6 months is what we need to educate the clients. But having said that, I'll come back to my earlier point. If we are focusing on, let's say, helping foreign companies come to India, 99% of the time you're dealing with companies which are under that automatic route. So we don't really have to worry about the government route or approval route, because if well, I've come back to this slide for that reason. If you look at the sectors that are involved there, there are very few sectors that need government approval route, and that too beyond the cap that is there here, right? So yeah, so that is again in terms of what is needed. Again, the documents with respect to the foreign company, their business performance over the last few years, that is their financial statements, the board resolutions authorizing investments, a comprehensive plan with respect to what they intend to do within India. A project report is what we'll need to submit along with the financial projections. And depending upon which sector they are in, how are they transferring technology from the foreign country to India, and how are we protecting any technology that is getting developed in India, not to ensure that they're not misusing that technology in a foreign country. These are some of the aspects that the government is keen on before giving them the approval. So this is on the government route. I think before I go to Suraj to see if there are any questions, I think I'll cover this again in terms of commencement of the entire incorporation process. What are some of the prerequisites that we'll need to look at? One is in terms of, again, how do we optimize the tax benefits from a global taxation perspective? Having said that, I think now there is enough and more awareness in the global investor community also, saying I will not set up something just to take advantage of or just to take tax arbitrage as an advantage. Gone are those days where they can just create a shell entity in one of those countries and route their investment through it and take tax advantage. I think globally there are many experts among our members who can speak more on this in terms of how global tax is evolving from the earlier regime where it was very easy to take tax arbitrage, right? So, but again, we do have some structures more from a business efficiency perspective and slightly less from a tax efficiency perspective. That is, again, let's say the Singapore route is one of the most popular route where the holding companies in Singapore and the subsidiaries in India. Mauritius route has been the traditional choice. Then we have Netherlands, you have US. But if you look at each of these countries, for example, if you look at Singapore now, there are adequate protection that is brought in within the Singapore framework, the legal framework, where they're insisting on substance being in Singapore. So I just can't create a shell entity in Singapore and say that is the parent company and India is my subsidiary. So I'll need to ensure that there is an office in Singapore, there are employees sitting in my Singapore office, there are board meetings that are taking place in Singapore, etc. So the substance requirements is come in with most countries now. And again, if you're looking at something like a Mauritius or one of these so-called tax havens, now obviously there's enhanced due diligence across the various regulators. This really doesn't matter, but it's important to understand where they're coming from. In the next section, I'll take up how this will have an effect on the documents that we as members need to review when we are filing the incorporation application. Along with the other aspects that we discussed so far, one important criteria that they might have is on repatriation. Yes, I've come to India. I've made some profit in Indian entity. This applies where, especially where they're doing some sort of trading or buying and selling in India. Now, how do I take my profits out? right? How do I repatriate my profits back home? So again, you'll need to consult with them with respect to a dividend repatriation framework. You need to again give them an overview based on where the parent company is located, do a quick check on the treaty, and then suggest them options for taking out the dividend, the RBI forms that will have to be filed, etc. around that time. And eventually, if there's an exit that is happening, if they decide to exit the country, again, what are the capital gains that will be applicable? What is the process for RBI approval for certain type of transfers, etc. is something that we'll need to educate them. Again, like I said, these are all requisites assessment. I'll also cover some other aspects which are very important. I think I'll just touch upon them now in detail. We can take it up later. Is one is, where is the Indian entity looking at raising the funds? Is it all entirely dependent on their parent? Or is it also looking at, let's say, at some stage, 2 years down the line, 3 years down the line, is it looking at raising funds in India directly? That is also an important criteria that you'll need to check with them at this stage where we are doing a prerequisites assessment. The second thing is, again, the team in India. Do they have someone who can be their resident director, or do they need our help in finding a resident director, etc.? So that's again an important assessment in terms of the planning stage. So I think with that, we'll just spend about 3-4 minutes in seeing if there are any questions around this. This is again, we've set the context, we've set what are the things that we'll need to be clear of before we get into the incorporation process itself. Like I said, as members, it is important for us to buy that time. It is for the long-term benefit of the client that we are asking all of these details at this stage. We can just do a templatized entity creation for them, but it is important for us to ask all of this, including the funding and the plan for Indian team at this stage. So before we go into the incorporation process itself, maybe Suraj, if you can just check if there are any questions or yeah.
Yeah, in forms of organization, right? What
Yeah.
we took. In that, how should a foreign company decide which form is most suitable for its Indian entry strategy?
Right, right, right. Good you mentioned that, Surajji, because if you look at the different forms that are available, right? So essentially, from a long-term benefit perspective, you should always go with a wholly owned subsidiary or subsidiary in some form where the parent company controls more than 50% of the state. The way I would advise clients is the other three are short-term temporary arrangements. And depending upon what you need to do in that short-term time frame, right, we can choose one of these three. So a liaison office, like I said, no commercial activities allowed. You're only and only doing research about the Indian market, or for some liaison activities that the parent company cannot come in here. Parent company needs to come in here and do. That is when a liaison office comes in. Project office, very clear objective. I am awarded a particular project to execute that. I need to be in India. And other than executing the project, I'm not looking at anything else. Right? That is when I will choose a project office. Now, branch office again, I am convinced about India, but at this stage, I'm not very sure if I should go all in, because we'll also come to that point at some stage that, let's say, when you incorporate a company, there is a compliance burden that comes in. There is also, from a global reporting perspective, consolidation, all of these things come in, right? So branch office, I would say, is a precursor to that, where you want to do or carry out certain activities, but at a very small scale. The moment scale increases, then you're getting into multiple issues like, how do I apportion or allocate the profits between the parent entity in another country or the parent entity in India? All of those issues will get into when you're doing a branch office. So branch office, I would say, is a precursor. But if you were to ask me, if you're convinced about India, then you can directly go for subsidiary, where you're still figuring out, how do I do this? I need to enter India. I'm still not very clear on the business model. I'll start off with this and then I'll do a wholly owned subsidiary. That is when branch office can be considered.
Okay, if we take a practical scenario, like
Hmm.
I just want to know whether my business will grow in India or not, I will start a
Okay.
license office. Okay, initially I will start a
Good.
license office. Or
Yes.
is there any
If
flexibility to shift from a license office to a wholly
correct.
owned subsidiary if
So
the
I would
business
say,
expands?
if you are again, if you want to start business in India in a small scale, then you need to go for a branch directly. Liaison is even just research. I cannot even buy and sell in India. In liaison, I can only research, interact with different parties in India, and pass on that information to the parent company. Right. So you start with a branch. You start with a branch. There's always an option where you can create a wholly owned subsidiary at a later stage. In fact, we have enough examples of some of these larger players who have done that, where when they entered the country, till the time all the approvals are sorted, they had operated as a branch office, an extension of their foreign operations. And once all the, especially those coming in through that government approval route. So you start off as a branch office, ensure that all the paperwork is in order, ensure that everything is in order, and then you sort of convert it into a wholly owned subsidiary.
Okay, and in our business model linkage,
Yeah,
I think there is a development center.
yeah,
So,
yeah.
if a company wants to set up a development center in India, so
Right.
would a branch office suffice, or is it better to have a subsidiary?
See, from depends on really two things. One is how many employees am I looking at hiring in India to help me, right? And B is how easy or difficult is it from a tax management perspective. So for a branch office, the tax aspects are that. So whatever profits are attributable to India, the amount of profits that are attributable to India, those are taxed in India at a rate that is applicable to a foreign company, right? When you go for a subsidiary, obviously you are now an Indian resident from a tax residency perspective. The Indian entity is an Indian resident. So do you do your transfer pricing assessment? Because you said development center, we typically do a cost plus margin, and then you pay taxes on that margin. So if you're just saying it's just one or two employees or three or four more employees, and I'll take enough precautions. Again, this is more from a tax transfer pricing perspective and tax residency perspective. I'll take enough precautions so that I'm not getting exposed from my PE risk to opening up my profits outside India to Indian tax or vice versa. Then branch is fine, but otherwise, I think development center is some. Otherwise, wholly owned subsidiary is where it'll make sense. Uh, Again, I think when we are discussing this, it's also important to highlight the nature of companies that are entering India has changed in the last 10, 15 years. And I think this is also important for us as members to understand. Back in the day, it was these large enterprises, Fortune 500 companies trying to set up a development center in India, etc., right? But in the last 10 years, things are very different. You have entities that can be classified as SMEs or SMBs in their home country, that is small and medium enterprises in their home countries, also looking at India. Like I said, that is a compulsion now. I call this as borderless business playbook, where if I can get a particular thing manufactured, or if I can get a particular activity done in another country with lower cost, at some point I'll need to look at it. If I don't look at it, then it's very difficult for me to sustain in the long run. So from the enterprise companies that were coming in the, let's say, early 2000s, now when you're looking at development centers or general Indian subsidiaries, the SMEs and SMBs from foreign countries are also looking at India, right? And when they're looking at India, we can always create a solution where they can create subsidiary in a very cost effective manner. Right, and that is where it's a huge potential for people like us. When enterprise companies, Fortune 500 companies would come in, they would have restrictions with respect to they will engage only these type of consultants, the top corporate lawyers in each country. They'll have an empaneled list which is prescribed by their board in the foreign country, and they'll not work with any partner outside that empaneled list, etc. Right? So that was the case in the past. Now, when you have SMEs and SMBs coming from each of these countries, it's a huge opportunity that we as professionals can tap into. So those filters or restrictions are gone. So it is important for us to acquire this knowledge of how do we help them come into India and advise them. And the reason I say that SMBs coming into India is important from this discussion is, see, SMBs are very clear. When I'm entering India, this is what I need from India. And I don't have potloads of money like enterprise companies to try out. I'll try out a branch model for 6 months, 1 year, and then I'll go into subsidiary model. No, they are convinced about India. It can be a small team of 15 software development executives or engineers sitting in India, or 20 or 30. It can be as low as that. They're convinced that I'll come in with a subsidiary where I have full control on it, right? So we've seen this transition in the past.
One more last question before you proceed.
Yeah.
Could you explain how a hybrid model works in practice, and
Yeah.
which entity structures suit it best?
Okay. So the moment you look at a hybrid model, we're talking about a subsidiary, Suraj, because hybrid model in a branch office, again, multiple tax complication. What do I mean by hybrid model? First, let me define that. Hybrid model is talking about Indian entity performing multiple functions. So Indian entity can be a shared support service provider, shared services support provider, where they are saying that global HR is managed from India or global finance and accounting is managed from India. But the same Indian entity is also selling goods on behalf of the parent company. The same Indian entity is also importing goods from the parent company and selling it in the local Indian market. That is when we'll have to be absolutely clear with respect to apportionment of costs. Because transfer pricing, again, we apply different margins, different basis of assessment with respect to each of the functions, right? And hence it is important to have a very robust system of capturing costs in the Indian entity, right? Capture costs and then allocation of costs also. The costs that are relevant for me performing the shared services function are different. The costs that are relevant for me selling the goods or marketing support to the parent company are different. I'll need to take all of these costs into different bucket and maintain very clear documentation with respect to this allocation and apportionment of costs, so that I don't get into tax troubles, especially from a TP perspective in future.
So you can continue with the presentation.
Right. Thanks, Suresh.
Thank you.
So now let's move on to the incorporation process itself. Now we've done an initial prerequisites assessment. We've understood the business model of the client. Now coming on to the incorporation process, I want to talk about some of the best practices again. I'll not talk too much about the MCA forms, etc., because all members are aware of it. Instead of it, I'll talk only of those aspects which are relevant from a foreign company perspective, where it's easier for us to incorporate a subsidiary. So first and foremost is in terms of name selection. Again, we'll need to educate the client with respect to what is the process of name approval in India. Now, one of the things that we as members need to do is all of us need to acquire this capability where we are just going and doing a trademark search ourselves. So on the WIPO global brand database, so I'm not very sure if I think I can quickly share my screen with it, because a lot of times they say that we own the trademarks, but they don't necessarily own those trademarks. So it's very important for us to do our own research in terms of do they have any international trademark, or we need to again go through a different process of name approval. I'll quickly share my screen with yeah, so there is a WIPO website. This is the Global Convention for Trademarks, where we can actually do a search. This is called the WIPO Global Brand Database. So the moment there's an inquiry from a foreign company about setting up in India, they'll give you their options, 3 options, 4 options. But first and foremost, we need to ask them is, do you own trademarks for any of the names that you're giving? In our experience, the moment we attach a WIPO trademark certificate, so we can do a comprehensive search here. This is the International Trademark Organization. Even Indian trademarks, which are approved by our Indian IP authorities, are consolidated into this database, right? So through this database, we can access and see what are the trademarks that they hold, in what countries do they have access to use these trademarks around the world, right? And it becomes much more easier once they own any of these trademarks. You support that, saying you submit a letter along with your name application that we filed, the run application, where we attach this trademark certificate with a covering letter and a resolution from the parent company saying we already own this name across in 2 3 countries, so you please allow us that name in India. We have seen no hassles whatever from ROC. Without this trademark, all the members must be aware right now, while we speak, in the last 2 3 years, one of the biggest bottlenecks for us that we are facing is name approval, right? And rightly so, because of so much of IPR evolution that we are having and people trying to use a name similar to another company name. So it is important for us to understand if trademarks exist, and then we can actually, in fact, there's no reliance on the parent company. We can search that these certificates are there. We can download those certificates, just get a covering letter from the owner of those trademarks. The other important aspect, practical aspect that members will need to be clear is they say that they own the trademark. But if you look at the owner of that trademark, for all you know, that owner's name will be different from the entity which is going to hold shares in the Indian entity. So again, it is important for us to educate them and say that the NOC or a no objection certificate for a letter for use of trademark has to come from that owner of trademark as per the WIPO brand database. Whoever name that is registered, it could be an individual who is the ultimate shareholder of the parent entity, or it could be one of their group entities. It is important that this letter comes from that specific entity. So to a large extent, my troubles with ROC as far as name is concerned get sorted when I have trademarks in place, right? If there is no trademark in place, then again, it's like any other domestic company where you'll have to very clearly say that this is not closely matching with any of the existing entities. We need to comply with the name rules that are specified as per the Companies Act. And then, yeah, so that's on the name reservation and trademark strategy. Again, I think as members, we'll also need to understand these clauses, some of the common clauses that are applicable for subsidiaries of foreign company class is class 35 business management services, 42 is again your computer services, IT services, etc. So these are some of the most common classes for which subsidiaries are being set up in India. Again, one of the things that a foreign company would probably consider, especially when they're looking at India as a market, is again domain availability. There's nothing much that we need to do except align that with the name selection strategy that they are going to follow. So that's as far as name reservation is concerned. The second one is a very important factor when we are working with foreign companies looking at setting up in India. Now, obviously, I have documents coming from outside India. And then the moment documents come from outside India, I have the requirement of getting them apostilled or getting them attested. So let's say when we started doing this work, right, where we're working with foreign companies, it was a surprise for us because in India, we get it notarized so easily, right? If you have 5 documents, 10 documents, 20 document, doesn't matter. I'll go get it notarized very easily. But the process for foreign companies when they're submitting documents in another country is not as simple as that. So we'll again need to understand if the country from which these documents are coming is part of Hague Convention or not. If it is part of Hague Convention, then the local apostilling process in that country, which can be done by their local equivalent of a public notary, is sufficient. But if we are dealing with any country which is not part of Hague Convention, then it is mandatory that we need a consular attestation. So again, it goes to the home country authentication. The Indian consulate in that particular home country will need to attest these documents, and only then we can submit it here in India. Otherwise, they are not a valid document. So it is very important. And here, I think we'll also need to understand as members when we advise clients saying these are the list of documents, we are absolutely clear that we take those documents which are needed in the process and not go back to them with saying we need a change in this got revised. Why? Again, we've learned it the hard way. For example, if you look at the charges of some of these, right, especially UK or Singapore, it costs about 75 pounds or 75 Sing dollars per document, right? So which means to say in Indian terms, in Singapore, they pay close to 5,000 per single document, 5,000 rupees per single document to get it apostilled. So we cannot keep going back to them saying, I'll need all of these documents apostilled. It is a time consuming process. It is B, an expensive affair in some of these countries. Hence, it is very clear that we maintain this documentation very clearly. We ask them, I'll give a simple example with respect to where things can go wrong. We ask them for a temporary or a present address proof. There's a permanent address proof or there's a present address proof, right? Which is typically their bank statements, etc. Now, there's also a restriction with respect to the validity of it based on the number of days, how many days old it is. So they will get this and send it to us. By that time, if that 60-day or a 90-day window is over, then that is not valid. So again, we go back to them saying, we'll need another document. Again, this process continues. In fact, for countries which are not part of Hague Convention, this is a complex process because we need to manage the timelines very efficiently. We have seen enough number of cases where we give the list out, the client collates that list, sends it to consulate or embassy for attestation. By the time it comes back, the validity period is over and things keep going in circles. So we'll need to efficiently manage this process. If they are part of Hague Convention, at least the timelines management part is easier. But where we'll need to be very careful is giving them that comprehensive list of documents that need to be apostilled. We can't go to them in piecemeal manner where we are just taking multiple times different documents, or we cannot just take a document just because we feel it is needed, except I mean, even if it is not needed from a legal perspective. A lot of times we do this documentation just so that to be on the safer side. But no, it is important that we see this is the list that is needed by the MCA, and only then we ask them for it because it's an expensive affair in those countries. In fact, we have seen some registrations where subsidiary registrations where the amount of money they would have paid to apostille the documents is almost as much as the fees that they paid us to incorporate their Indian entity. So notarization or apostilling is a very important aspect of this. And this also involves a lot of time, because the moment you have one of the subscriber to the charter document, that is the memorandum, who's a non-resident, then your entire, I'll run the entire incorporation process digitally with DSCs will not work. So we'll need physical signatures on the memorandum and articles, and then we upload those documents online. So that's a key difference between all resident subscribers, where you can just take a DAC for each of them and do it completely online, versus this. So we'll again need to be clear. So careful with the timelines. So one of the workarounds that is available to easily manage this, because maybe we don't have the luxury of time. Maybe let's say the client says, I need this entity up and running in two months because I need to hire my employees, which is very critical for me. So then one of the models which is being widely practiced these days is the entity is set up with Indian resident shareholders, the first directors being Indian residents. The entity is set up. There's another undertaking between these resident shareholders and the parent company from outside India, saying they're just beneficial owners of this entity, right? And as soon as the entity is set up, right, operations can start, bank account can be opened, employees can be hired. So the timeline is managed effectively. In the back end, the Indian residents transfer these shares to the foreign parent company. Why? Because there we have the luxury of time. Obviously, you'll need to comply with the same RBI regulations. Here, you file, if the parent company is investing directly, you file FCGPR. In the other case, you start the company with a resident shareholder, then the resident shareholder transfers these shares to the foreign parent, in which case you file FCTRS once the share transfer is done. So you'll still need to comply with all of that. It's just that it gives you the flexibility of time, where in the first case, where the foreign company needs to be a subscriber to the memorandum, you're waiting for all of these documents to come from different parts of the world, and all of them to be, apostilled, or in some cases even consulate attestation, and then only your incorporation process will move forward. So to accelerate this process, this is a workaround which a lot of companies are working with these days, where they get nominee shareholders or nominee directors to incorporate the company, who will then transfer the shares to the parent company at a later stage. So this is on the document part. Then again, what are the certain other things that we'll need to be mindful of? All the members will be aware that out of the two directors, at least one director must be a resident. So hence again, in the initial stages, you could also have situations where the foreign company has not identified the Indian resident director. So again, another avenue for a lot of members, very similar to the independent directors, this thing is the nominee director service, where a lot of foreign companies are looking for a nominee director till they recruit, let's say, someone like a country head in India or a managing director in India who will lead their India operations. They'll want someone ideally referred by a trusted advisor or a professional like us, who's helping them with the entire incorporation process, to also refer them a nominee director who can meet with the requirement of having one Indian resident director on board. Then again, we don't have to worry about the independent directors. The other, this thing is, yeah, one of the common things. Even yesterday, we were on a call with a company where DIN issue. So with Indians, it's fairly easy to see if there's a duplicate DIN, and see if the older DIN itself can be used, right? But typically, what happens with foreign individuals coming in as directors is, for all you know, the passport that is given to us, let's say in the year 2005 or 6, when they had incorporated their first entity in India, passport number is different. Hence, I got a DIN already. Now, for whatever reason, that passport has expired and new passport has come in, and hence the DIN is different. So there's no PAN DIN check here, right? So which means to say there's a higher risk of we applying for a duplicate DIN for a foreign national than in case of Indian resident, because that PAN unique identifier is not there. Hence, again, it is important for us to understand the background very clearly, not just of the company. So this is something that we do in our initial discussions, where we ask them very clearly if they've been part of any business in the past in India, if they've done any business with any other Indian company in India, because it's possible while they were doing business with them, they've applied a PAN for this foreign national, right? All of these things are possible. It's very important that we do all of this in our assessment stage itself. So one key aspect there is, whoever is the proposed director in the Indian entity from the foreign company, we'll need to do a thorough check to ensure that they don't already hold a DIN, or if they have a PAN, then we need to link that in our current application. Now, with respect to visa norms, it's quite liberalized. Even if you were to have a physical in-person board meeting or an AGM, it becomes very easy, except a few countries where there are restrictions. Uh, the other important aspect that we need to be clear of, again, it's something that's very critical in the last few years, is the significant beneficial ownership. A lot of times they might ask questions like, how is that relevant in India? Why do I need to give this information in India? I'm giving you the parent company details. But again, it is important to tell them very clearly, saying I'll need the parent entity details, but also the shareholders of that parent entity. I'm sure the members would follow the recent news of where they'll try to create shell entities in different parts of the country, and then the money route gets routed into one particular country, or just to circumvent the restrictions or sanctions that are there on few countries. This is being done, right? So hence it is very critical. We set the expectation very clearly that we are not just interested in who owns or what is the cap table or shareholding pattern in the Indian entity, but we also need to get that right down to the topmost layer of the holding company, right? So if there's an immediate holding company, then who owns the shares there? If one of the shareholder is a company in that, again we get into the shareholding of that entity. So we need to clearly mention this to them. Authorized capital planning, again, now again members would be aware that it doesn't really matter. There's no minimum capital requirement as far as the company's act is concerned. But having said that, we typically advise companies on the basis of what their funding requirements in future are. So like I said, there are different models, right, based on the business model. If they are looking at setting up a manufacturing facility in India, for example, then obviously instead of doing a lower authorized capital now and again increasing it and going through the paperwork again, we suggest them to do a higher authorized capital at the beginning, especially if they are planning to fund that entire factory or plant setup through foreign equity. We again ask them if there is any plan for raising ECB. Again, we take that into consideration and say that if you have plans of raising ECB, then this should be your capital. Authorized capital discussion or decision becomes the most easiest when we are working with development centers or captive cost center where they're billing their parent company. Why? Because I just need authorized capital to get going. What happens after that is everything is funded by my parent. So first month I incur 100 as expenses. I bill them 115 or 120 based on my TP margin. So the money keeps coming in, right? So I don't really have to worry about authorized capital as much in case of a shared services setup or a development center setup compared to an Indian entity which is looking at India as a market, could be looking at setting up manufacturing in India, or could be looking at trading in India, etc. So there we'll need to factor in the amount of money that they will need in India, right, to get their operations going and to also cover their initial working capital requirements. Now, if they have plans of ECB, then that is separate. So essentially, we need to lay this out to them saying, boss, okay, in this business model, you'll need 3, 4 years for India to generate consistent cash flows, cash positive, to be in India. Till then, you'll need to support it. So how do you support it? Will you support it as equity or will you support it as ECB? If it is equity, then better to have a higher authorized capital. If they say a mixture of both, then I think we can keep a nominal authorized capital till the time we get ECB in, and after that, ECB is enough to cover the subsequent funding requirements. So that's on the structure part of it. Coming to RBI, now while I've mentioned the different models that are allowed by RBI in general, specifically when you're looking at unlisted private entities and foreign investment into unlisted private entities, we are looking at DCF. So DCF is the method that is allowed. The second thing, again, this is something that we'll all need to be very careful of. While Companies Act is prescribing for registered valuers, IBBO registered or accredited valuers, when it comes to RBI Master Circular, as CS, I can get corrected on this, but if I remember correctly, anyone with over 10 years of practice or five, I think it is 10. 10 years of practice, anyone with over 10 years of practice experience, we are authorized to sign the valuation certificates from an RBI perspective. So in fact, it can be a SEBI registered merchant banker or any chartered accountant with 5 or 10 years of experience. I can get that checked. So with 5 or 10 years of experience is authorized to sign the valuation certificates as far as FEMA regulations are concerned. So this is from a pricing perspective. Now, why is this relevant? Again, there are two aspects here. Like I said, either the foreign company is buying into the is subscribing into the initial memorandum itself, or an Indian resident is transferring shares, right? So if it's a direct allotment, it could be through subscription at the time of MOA, or it could be a future issue of shares by the Indian entity to a foreign resident. In those cases, we'll need to comply with RBI norms, pricing norms, where a valuation certificate is required, and also documentation and filing. So the filing requirement is essentially what we call as FCGPR, where we file the documents with RBI after the share allotment or share issue has happened. So that is a direct share issue or a primary issue from the company to the foreign shareholder. If it is a share transfer, like I said, one of the workaround that is being considered in the recent past is you incorporate the company with Indian shareholders and then you transfer the shares to the foreign company, right? So in those cases, we need to file what we call as FCTRS. So that is relevant for secondary transfers, right? Secondary sale between two individual transfer of shares between two individuals. Again here, as far as documentation is concerned, it's almost similar. Some of the practical issues that we face is, again, there is a dependency with the banker here, because these forms, a you'll have to create a master file with RBI and then file these forms, a business entity file with RBI and then file these forms. But more importantly, there's also a dependency with respect to what we call as FIRC, which is foreign inward remittance certificate, where the banker will have to give a certificate saying, yes, this is the amount that this company has received, and this amount is received towards issue of shares by an Indian company towards a foreign resident or a foreign entity, right? Now, FIRC, some of the common issues, banker is very particular about exact amount coming in. And with Forex flux, that becomes a challenge, right? So let's say I'm issuing shares to the tune of 10 lakh rupees to a foreign company or a foreign resident, right? How do I ensure that only 10 lakh comes in? So now it's a normal practice that we keep a buffer. So they send equivalent amount of dollars, Sing dollars, Canadian dollars, doesn't matter, a foreign currency to the Indian bank. Indian bank converts it, and anything in excess will have to be sent back to the transferer's account in the same SWIFT, right? So then the banker will be able to issue us FIRC, which is exactly matching with the value, the consideration for transfer or the consideration for allotment of shares, right? So that is something that is absolutely critical. Then the bankers will have to insist, they generally insist on what we call a six-pointer KYC. Again, this comes from your prevention of money laundering provisions, which is globally adapted to ensure that I need to be very clear of the KYC of the transferor who is subscribing to these shares in India or who is buying these shares in India. Hence, bankers have a standard format which we call a six-pointer KYC. And the moment your parent company or transferor is initiating this transfer. Now, when I say transferor, it is the money transfer that I'm talking about, not the share transferor. So, in the buyer of the shares, when they're transferring the money, will have to give these six-pointer KYC details to their banker, which generally they would have, and they'll have to communicate that to the Indian banker. Only if they do that will a FIRC come in properly, and then FIRC is a mandatory document for me to file with RBI as far as FCGPR or TRS is concerned. Additional documents will include valuation certificate, and there's also a company secretary certificate that we'll need to obtain saying all the Companies Act related compliances as far as issue of shares are complied with. And then in case of TRS, it's always better to keep the share transfers agreement, share transfer forms handy. So these are some of the RBI or FEMA related practical considerations that will have to be kept in mind. There is another aspect which will have to be very careful of, and educate the foreign remitters or transferers before they're doing the fund transfer. Again, when they're transferring the funds, it can come in foreign currency with very clear instructions saying anything in excess will have to be sent back. That is point A. There are also certain cases where they credit it in INR into the company's account or to the share transferer's account. Now, those are mostly cases where there's an intermediary bank involved. And we have had enough number of cases where it was difficult to chase these intermediary banks, because now the question is, hypothetically speaking, let's say transferor has or the buyer of shares from the US has sent money to an Indian entity's account in India, and they have an account with, let's say, ICICI. Now, the moment they send it in INR with an intermediary bank, ICICI will not be able to give the entire documentation that we need for FCGPR or TRS. Why? ICICI has received this money in NEFT and not foreign transfer because there's an intermediary banker involved. So again, as professionals, they'll come back to us and we'll need to first identify who that intermediary bank is. It could be SBI or one of these banks. So now you're dealing with two banks. So now the intermediary bank will have to give a go ahead to ICICI saying, yes, boss, these funds are received in foreign currency. This is the foreign currency amount that is received, and these are the 6-pointer KYC, which is again very critical, right? These are the KYC details of the eventual investors, and those details the intermediary bank will have to share with the bank of the Indian entity, and then only then they'll be able to give an FIRC. So we have gone in circles with respect to following up with our bank, then the intermediary bank. So again, it's very important that we educate the foreign companies when they do this. Try to avoid that whole intermediary bank in between, so that we are at least dealing with only one bank. So yeah, these are some of the practical issues as far as issue of shares and RBI and FEMA regulations are concerned. Then coming to ECB framework, again, very liberalized compared to how it was earlier. As per the 2019 guidelines, you have different tracks, and most of the sectors are now allowed to take loans from their parent companies. So ECBs get slightly more regulated when you're taking a loan from an external investor or a non-parent company. But the moment you're taking it from a parent company, and this parent company details are already there with RBI by virtue of you filing an FCGPR or a TRS, where in this Indian entity that company is tagged as a parent or a shareholder, then it becomes easier to take ECB loans. There are certain activities for which these are end use related activities for which ECB loans are not allowed. Again, real estate activities, you're not allowed to take loan from your parent and invest in Indian stock market. Or with respect to lending, again, if you're an NBFC or a bank, there are very clear guidelines with respect to what is allowed, what is not allowed. Working capital, there are certain restrictions, but there is also something called as general corporate borrowings. So at the moment you say it is for general corporate borrowings purposes, and then again, depending upon the track that you're in, it is quite liberalized. How do we professionals again help our companies in this? Again, it's a very fairly simplified process. But one key aspect or key stakeholder as far as the entire RBI FEMA compliance is concerned will be the AD1 banker. That is the banker who's dealing with the company, right? So it is very important, be it from an FCGPR TRS perspective or be it from an ECB perspective, to understand what is needed as per RBI and to comply with it. Because what is needed by RBI has laid that down. But unfortunately, in most cases, uh, we'll have to deal with the AD1 bankers. So where does this submission happen with all the ECB paperwork? I'll need to submit it to my banker. So my ECB loan agreement has to be submitted to the banker, and it is the banker's role to actually review if that agreement is in compliance with the ECB framework laid down by the RBI. Hence, it is very important that you consult with them, tell them well in advance, understand their documentation requirement, because again, like I mentioned earlier, we give them a set of 10 documents, then the banker says no, these 7 are fine, 3 are not fine, get it changed. That getting it changed, again you're going back to the parent company, right? So all of this will go in circles. So instead of that, it is very important that you get your draft loan agreement itself vetted by the AD1 banker and then execute it. There are other parameters like what should be the spread, what should be the minimum duration for which you need to take this loan, or what's the maximum duration within which you have to repay this loan, etc. So that's all laid down in this ECB framework. But like I said, it all becomes easier. The two crucial stages are, one is at the time of taking the borrowings, we'll need to draft something called as ECB loan agreement between the borrower and the lender, where we are very clearly laid down the terms of repayment, the interest rate. Interest rate can be linked to one of these international benchmarks. It could be a Libor plus X percentage or any other spread that is allowed. And then very clearly get this vetted by the banker and then get it executed. Once it's executed, then we'll need to only look at the FCGPR that was earlier filed. And then there's an ongoing compliance that is involved with respect to, let's say, every time I pay interest, I need to submit some documents with the banker, right? So that's an ongoing compliance as far as ECB is concerned. So this is with respect to the funding, the equity, and ECB. Then again, with respect to transfer pricing, because if the business model is such that you're dealing with your parent company or one of the group entities where you're providing them some service, Again, it's important that we keep the documentation very clear with respect to organizational structure, what is the function of the Indian entity, right? The detailed business description, who owns the IP, is the IP getting created in India, where is the IP getting created, who is licensing the IP to whom. So this is more from a master file, and there's also a local file requirement with respect to Indian subsidiary details. So the moment you're looking at a cost center where you're dealing with only your parent company, it's important to get this structure right as far as transfer pricing is concerned, where you do a function asset risk analysis called FAR analysis, benchmarking study, etc. So these are the standard things. I'll not dwell too much into the GST and other aspects because these are fairly straightforward and these are very similar to how you're dealing with a domestic company. So this is not very different. The only aspect that I think we as members need to be very clear of is when you're setting up a development center or a GCC or a GDC, most likely that, I mean, not most likely, it is that you're dealing with your parent company. Hence, irrespective of the turnover, I need to go for my GST registration immediately. One other criteria, I think, along with the GST, I'll probably want to cover is that assessment of SEZ versus non-SEZ. Again, we can be a good advisor in terms of understanding what services they provide, how dependent are they on, let's say, Indian vendor ecosystem, or is it just employees they're dealing with? Based on that, we can also suggest them SEZ versus non SEZ options. And then other documentation, especially from an international trade perspective, is again IEC code. Again, members would recall how difficult it was to get IEC in, let's say, mid 2000s, or to that, for that matter, even 2010, 11, 12, etc., where they were insisting on hard copy files going there in a particular format, and they would insist on a specific format for the bank certificate and all of that. From that to now, I was pleasantly surprised a few years back where they said it's completely online, and the team said, sir, in 15, 20 minutes, we were able to file the application and the code is instantly generated. Like I said, this is one of the key focus areas from a government perspective also, where they have comprehensively restructured DGFT's interaction with the business, right? So as part of that, one of the benefit is that now IEC has become super easy. And then again, if the client is specifically to import and export, then their documentation around that. Maybe members can help plan their GST itself. How do we take credit? Or if you're into export, then do we go for the refund option? Or do we, how do we plan the entire GST structure is an area where we can really help the business. Again, LUT, etc. Again, I'll not go too much into it because this is something that all the members are already aware of. There are also certain export incentives and benefits that businesses can tap into, like the RODTEP scheme. Earlier, we used to have SEIS, MEIS. Now it's the RODTEP scheme that is like a general scheme that is there. We can, again, like SEC, I have already covered. We can go through those documents and see if it is relevant for the business model that the client is setting up in, and we can assist them. And it's also important, depending upon the country from which the parent company is, that we also go through the free trade agreements. India has, so as CAs, we are normally very used to reviewing the DTAAs, but I think we'll also need to make a habit of reading the FTAs now, considering the global trade now. So major FTAs, again, there's an Indian ASEAN FTA, there's India Korea FTA, India Japan CEPA, right? There's India Singapore FTA. So it's important that we go through these FTAs and see how there are, in most cases, there are liberalized import clearances, export clearances, remission of duties, etc. So we can go through those FTAs to see if we can give any advice which will benefit the client. Again, I'll not spend too much time on this as well, again, because it's fairly simple compared to the domestic entity registration. It doesn't really make a difference from a subsidiary or a domestic entity perspective. So this is employee related licensing as far as PF, ESI, PT is concerned. And then there are industry specific licenses that are there. Industry specific licenses, again, all boils down to if you are availing any benefits under SEZ scheme, or a lot of state governments of late have been very proactive where they're setting up their own industrial promotion parks. Let's say I come from Bangalore, where we have this aerospace park, textile park, etc. As part of this, there are again certain incentives that can be that the client can benefit out of. So we can again prepare a comprehensive document where we can list out these incentives and help them comply with some of the restrictions that they place. Usually state government conditions would be about employment generation, about your exports exceeding a certain threshold. So these are the conditions that are there. As long as we give them a project report saying we'll meet all of this criteria, we can become part of these parks. It could be a tech park, it could be an export development park, textile park, etc. And based on that, we are allowed to take certain benefits as well. So this is on the setup process. I think before we move to compliance calendar, maybe Suraj, you can check if there are any questions and maybe we can take them up.
Yeah, one question is how important is trademark clearance and name reservation at the initial stage? And what
Yeah.
are common reasons for rejection of this name?
Right. Uh, Again, I'd mentioned this while we're talking about trademarks, right? It is very important from our perspective as professionals to actually do an independent check with respect to if they have any international trademark in any of the countries. It doesn't matter that it needs to be valid in India, in any of the countries. If they have it, it becomes very easy for me to get that name approved from MCA because I'm already using that name elsewhere. As long as there is no competing or conflicting name of an existing company in India, that goes through very easily. The problem would be if I don't have a trademark, then we are dealing with this process very similar to how we are dealing with a domestic company. But the problem here is, in case of a domestic company, I can tell a new entrepreneur who is starting a new business to think of three or four options. The problem here is the foreign company is already decided on only that one name being there in any of their options, right? So if there's an Indian company, again, I'll need to go back to them, tell them very clearly, you don't have a trademark, that's your problem, right? So hence, you'll need to think of an alternative in India because there's already an Indian company which exists with a similar trademark.
Yeah, and one more. What is the typical timeline for incorporation if
Yeah.
all documentation is in order?
Right. So generally, like I said, out there, there are people who will say 2 weeks, 3 weeks. There are some who will say 2 days, 3 days. I normally set the expectation very clearly to any foreign investor coming to India saying it is a 2 to 3 month process at a minimum. Why is that? Again, like I mentioned at the beginning, it is very important for us to understand their objectives, understand their structures. If need, we propose and recommend them with respect to who the initial director should be, what the shareholding pattern should be, etc. So there's no point we promising them it'll be done in 3 weeks, 4 weeks, and all of that. So I give them a very realistic estimate saying it'll take about 2 to 3 months. If you are very particular, if there is an urgency, then you evaluate the second route where you tell us if you have any nominees in India, we'll incorporate the company in India with an Indian resident as shareholder, Indian residents as shareholder and director, and then we'll do a transfer. So then once the company is incorporated, you can start your business. Then we'll do a transfer of shares and change of directors at a later stage. In that case, we are looking at about 4 weeks timeline if you're looking at Indian shareholders.
And one question our participant asked is, are the regulations the same for Chinese companies for India and
Yeah.
in comparison to other countries?
No, I think that is something that a very clear distinction for all of us to understand is the way we look at it is any country with whom we share a land border, different rules, right? Very simple. It is not Pakistan, it is not China, it is not this thing. Any country we share a land border with, different rules, a different set of rules will apply. Any country with whom we don't share a land border, a very liberalized FDI scheme will apply.
Okay, okay. And one more, one participant asked, what is source of study of these data?
Yeah,
What
we
you are,
have government reports, we have this thing. So, any number that's put up there, we have a research report, let's say, on the number of companies. In fact, I found it very difficult to get the data of number of companies. And then I realized there was a question asked in the parliament about how many foreign subsidiaries are set up. So, we have taken it from there. So, for each of the numbers that are put up there, there is a particular source. If there is any specific information that they'll need the source for, we'll be happy to share.
okay, one more question. How do you rank the various states of India in terms of ease of business if a foreign entity wishes to establish an office in India?
Okay, I'll not want to get into that. Like I said at the beginning, we all have our regional aspiration, language, linguistic aspirations. So I'll not want to get into it. So the only thing that I can say is things are very different from how they were, let's say, late 90s, early 2000s, where only one or two states were vying for foreign investment. Now every state is very proactive. Every state has set up their own, foreign investment promotion board where they're very aggressively getting, proposals. In fact, they are going out and pitching to investors. If you look at some of these forums like World Economic Forum in Davos, It's not one or two states. Almost all the states will have a representation there. If you look at some of the famous the road shows or trade shows that happen out of the country, most of our states are participating there. So I can't name out or single out one particular state, but there's a definite improvement across all states.
And last question, if a director holds 60% of the shares in a foreign company
Okay.
and later acquires 99% shareholdings in an Indian company,
Okay. So
will the Indian
the
company be
earlier
considered
holds shares in a foreign company, and I'm
foreign
assuming, I think
company?
they're talking about round tripping. I think
Yeah.
the question is more to do with that. Yes, round tripping is not allowed.
Uh,
Where what is round tripping? Round tripping is where, let's say, I am an Indian. I create an entity outside. I own the shares in that entity, and that through that entity, I again I'm trying to buy shares in India. That in RBI and FEMA language is called round tripping. Round tripping is not allowed. Hence, that is why, in fact, one of the criteria is we give declaration saying there's no round tripping, but more importantly, one of the criteria where why we take that SBO ownership details is also this to see who's the ultimate beneficial owner. And if that leads back to you, that is not allowed. So round tripping is not allowed. Then members can might as well argue that there are a lot of companies who have done it in the past through shell companies and all of that. That is as per the regulations that exist today. It is not allowed. People have done it. They've had their innovative, inventive schemes and all of it, which we don't do, right? So that is there. As far as the rules are concerned, round tripping is not allowed.
And one question is that since at least two shareholders are required
Yeah,
to form an Indian subsidiary,
correct.
so he's having two part in question. Number
Sure.
one, can both the shareholders be non-resident body corporate?
Yes,
This is the first question.
sure. Okay. I think you can give both the questions and then I answer them. Yeah.
Yeah. And second one, if one non-resident body corporate and one nominee individual shareholder, what all compliances are to be done to make this individual shareholder as a nominee shareholder of the main non-resident body corporate?
Sure, good. So I think, yeah, this is one of the most common practices because when we talk about wholly owned subsidiaries, 100% of the shareholding needs to be with the parent company, right? Yeah, two body corporates are allowed. Only thing is we need to have two different parties. It can be 99.999% with one body corporate, 0.0001% with an individual or body corporate. That is allowed, right? If it is with an individual, right? I'll again need to very clearly articulate and state that the beneficial interest in those shares lie with the company holding that 99.99%, and this person is only acting as an agent or a representative of that parent company, which means to say, though on paper, let's say I am the nominee shareholder, where because we need to comply with the requirement of having two shareholders, they're insisting on me holding that one share. It could be 10,000 shares in the company, 9999 are held by the foreign body corporate. One, they're asking me, and I could be a foreign individual or I can be an Indian individual, right? They're asking me to hold that one share. So it is very important to capture that in an agreement between me and the foreign body corporate, wherein I say that I hold these shares as a representative of the foreign body corporate and the beneficial interest in these shares belong to the foreign body corporate. And I'll need to also do the forms, the Ben 1 form, which we'll need to file, where we are very clearly saying that though the shareholder is this, the beneficial interest lies with someone else.
Okay, the questions are pouring in.
Okay.
Now, one more question. A foreign company wants to take over an Indian company at face value and
Foreign
wants to
company wants to take over Indian company at face value. Okay.
pump in money for work. So the
Sure. I
Indian
think
company has
yeah,
uh,
sorry.
yeah, the Indian company has only an expenditure for preparation. Can they take over at face value, assuming all regulations are being complied with?
Exactly. So it'll all boil down to that, right? If it is an Indian company where there are not much of operations, where the valuer will issue a certificate saying boss face value is the fair value. It all boils down to that, right? On the other hand, you can't have a very profitable Indian company where it's been running operations for a few years and then say boss DCF I do and the fair value is face value. That you cannot do, right? But on the other hand, if it's a company which has been in losses or if it has just started and operations haven't commenced or etc. for whatever reasons, so then if the DCF value is justified, if the valuer justifies saying that boss, my fair value and face value are the same, hence I'm investing at face value, that is allowed.
I think we will continue with the presentation, then we'll take up
Sure.
the rest of the
Okay.
questions.
So I think what we are left with is the last leg of the presentation here. So typically, again, ongoing compliance. Again, I'll not want to focus too much on the ongoing compliance, which is applicable to all entities, because learned members will be hands-on with respect to that. I'll only talk about some of these specific aspects which are relevant for foreign subsidiaries. One is what we call as FLA, which will need to be filed with RBI. Again, this is like the moment you have an FCGPR or an FCTRS already filed, this becomes a mandatory requirement the moment I have any foreign equity, foreign liabilities, etc. So that is FLA that I need to comply with. Then, like one of the members have just raised a question in terms of what is the compliance if I have a beneficial ownership. So that is the BEN1 form that needs to be filed. So declaring the beneficial ownership, saying X percentage of shares held by so and so shareholder actually belongs to the beneficial interest in that belongs to the ultimate foreign body corporate. APR reports are again relevant, especially if you are getting them set up. These subsidiaries are set up with in any SEZ zones, etc. Then again, we'll need to give a report of the performance of the Indian entity, the like I said, the export achievements, number of employees, etc. APR is also relevant when you take ECP, any loan from your foreign body corporate or foreign parent. That is when our APR becomes relevant. Again, FLA filing is this thing. So income tax, I think all of these are standard. I'll not touch upon too much, but I think one of the things is TP and the second thing is SFT. The moment you issue the shares and you have money coming from outside India, then again, SFT is something that you'll have to be careful of. If you are doing any remittances to your parent, then your entire standard process of 15 CACB will get triggered and you'll have to comply with that. Companies Act point of view, one of the things that we'll have to be very careful of is the moment you're a subsidiary of a foreign entity, the benefits that are there from a small company perspective are all taken away. So you will not qualify as small companies. So which means to say the exemptions with respect to some of the exemptions with respect to financial statements, etc., or it could be your board meetings, etc., are taken away, and hence you are treated as any other private company as far as companies that compliance is required, right? Uh, the next thing again, an area where I think we can be very proactive as members is with respect to reporting, etc. Again, there is an avenue for us to support them with respect to translation, where the Indian entity maintains its books in Indian GAAP or Ind AS, but the parent prepares it in any other GAAP. So that is where we can pitch in and then we can do translation services. Because it is, if you look at reporting structures, right, there is India reporting, there's also a global parent reporting as per their gap from a consolidation perspective. Then there is tax books or books to tax adjustments that we'll need to do. And then there is management reporting also. What we have seen is, again, as CS, we can play a very proactive role. Right now, we already do it with respect to statutory reporting and income tax compliance. But one level above that, where we have parent gap and global consolidation, and one level below that, where we have management reporting, also, we can play a very proactive role, because for the simple reason that using technology, it becomes very easy. And the series itself is Global Udan series, right? So it's not necessary that I, as Indian CA, will have only knowledge of Indian gap. It is very relevant for me to have acquire knowledge of US gap, Sing FRS. And while I say that, I can very confidently say that it is very easy now compared to 10 years earlier. Why? Because most of the gaps are now synchronizing towards IFRS. So our Ind AS, for example, we've moved from Indian GAAP to Ind AS. Similarly, all the countries are getting harmonized. It's called harmonization process, where we are harmonizing or adapting IFRS itself. Some countries have directly adopted IFRS. Some countries have harmonized their standards, like how we as Indians have done. We said there is Indian GAAP, there is IFRS. I can't adapt IFRS as is. So I'll harmonize towards IFRS, and that's how I've adapted Ind AS. Similarly, most countries have done it. In fact, US GAAP and IFRS, the differences are narrowing, right? So considering that, it's important for us to acquire the knowledge of IFRS so that we can help them in parent gap or global consolidation, because we've seen enough number of clients where even if they have a local finance team, they'll want us to review the numbers before it goes to the parent company for their global consolidation, or in fact for their MIS as well, because it gives them that additional. So what we'll need to understand is there is a parent company and there's a team in India. We can be the trusted advisor who will review the numbers that the Indian team is giving, and then we can accordingly help the parent company make their decisions. And while we are doing that, it is important for us to also identify the technological solutions, especially from a TP perspective. If you are a multifunction entity here in India, then maintaining your cost centers, tracking of costs across cost centers, etc., is critical. Hence again, we should recommend the client in using a good ERP. It's not always the enterprise ERPs. I think here we mentioned some of the enterprise ERPs, but some of the Indian cloud accounting tools are also will be sufficient as long as we are giving them the reports in that function. On the other hand, if consolidation is enabled in an Oracle or SAP or Dynamics 365, then obviously as part of that, the Indian entity also, the expectation is that we'll use these softwares or tools in the Indian entity. Then we can again assist them with respect to translations or review of these books. The other area where I think some of the typical cost centers or 100% subsidiaries of foreign companies will need assistance is just preparing their revenue computation, right? I'm sure members who have done audits or internal audits of these companies would be aware. Just to ensure that the revenue that is booked is as per the TP norms, right? As per the transfer pricing study itself is a task in itself, right? So again, we can assist them in just a quarterly review of their costs and expenses, and then applying the appropriate TP margins into that and raise a quarterly invoice onto their parent company. Again, is something that is very critical. The other aspect is just tracking the inflows and outflows from foreign currency perspective, because it's now there is enough awareness, but generally what we tend to do is I have this receivable from parent company, I have this payable from my parent company, will knock it off. Not allowed. You're not allowed to set off, even if it is the same party, you're not allowed to set off a foreign currency receivable with a foreign currency payable. You're allowed to do that only after RBI approval, by the way. So, hence, again, these are some of the things that we'll need to ensure that it is not done from a reporting or even from an accounting perspective. So, the other thing would be to ensure that the timelines are followed. So if I have a foreign currency receivable, ensure that it is received in 1 year. So there are different timelines for each of these: 270 days, 1 year, etc. Similarly for foreign currency payable, if you need to set off, then get the RBI approval for set off very clearly. Maintain distinction with respect to what they need to pay you for, let's say, advance for services. Like I said, typically when you are a GDC or a shared services center here in India, you're entirely reliant on the parent company to give you funding, right? But you've not started working yet, so you have not raised an invoice yet. So typically what happens is they send in an advance for services first. So that advance comes in, again the forex repo of that, to ensure that that advance is knocked off against invoice within the RBI stipulated time period. So all of these are also some of the aspects that we as members need to be very clear of. It could be we working in one of those organizations or doing management reporting, or we could be auditing one of those entities. We'll need to be absolutely clear of these aspects from a reporting perspective. Right. So, yeah, maybe I think we have about 15 more minutes to go. We can take up the other question.
Okay, yeah. One question is that, yeah, are there any exemptions under the Companies Act for foreign subsidiaries that qualify as small companies?
So I think the moment you are a subsidiary of another entity, that whole umbrella of a small company is lifted. Right. So, and when do you become a subsidiary? You're a subsidiary of another body corporate. So back in the day, we had this debate again with respect to would, by virtue of being a subsidiary of a foreign body corporate, uh, will this exemption go off, or is it only for subsidiary of Indian companies? Now it is quite settled in from terms of secretarial practice also, saying the moment you are a subsidiary of any body corporate, your exemption of being a small company is taken away. And I think there's another question which
There is a question that what I asked earlier.
right.
He is asking
Mhm.
whether a foreign director holding 60% shares in foreign company becomes a
Okay.
director in an Indian company with
Uh,
more than 90% shareholding, will be Indian company be called subsidiary of foreign company?
no, I think so. Let me get the facts right. So there's a foreign director who holds
Yeah.
60% of the Indian entity, or
director holds 60% of the shares in foreign company
Okay, a director, okay, a person holds 60% of the shares in the foreign company. Great, okay.
and later acquires 90% shareholding in an Indian company.
That person or this entity?
Person.
Okay, so basically, I am a person. I have
Hmm.
60% of my shares in a foreign company, and I also hold 90% of shares in in an Indian company.
Hmm.
Ah,
Yeah.
okay. So this is called common control. Understood. I think I get what is the question. So these are called common control cases. What do I mean by
Hmm.
common control? So the controlling entity or the controlling person is same in both the cases, right? So that entity is not necessarily my parent. We don't call it as a parent company, but yes, it is a related party. The moment you're doing business with any company with which you have common control, then all your transfer pricing provisions will apply as is, because that's also an associate enterprise from an income tax perspective. And it's also a related party from your Companies Act perspective. So, though it is not technically a parent, by virtue of having this common control, it is a related party.
Okay. Related party, not a subsidiary.
Yeah.
Okay. And one question is that is compliance mentioned by you for both listed and unlisted companies?
In fact, I focused on compliance for unlisted companies, right? For listed companies, especially, I think most of the compliance will remain as is. On top of this, for example, when you are doing a valuation of shares of listed companies, in addition to the rules that we discussed, we'll also need to look at SEBI regulation. SEBI has certain regulations, and in fact, RBI also. I have covered DCF more from an unlisted company perspective. If you're looking at listed companies, then you're allowed to take, you're not allowed, you're required to take the price on the basis of the transaction price happening in the active market, right? So there are a different set of regulations that will come in for the listed companies.
Yeah. Next question is on ERP. Does our regulations allow access to our ERP by the foreign company as
Right.
the
So
accounting packages
sure.
run from them to avoid cost in licenses?
So that is again a big point, more from a backup perspective. Access is not an issue. You need to ensure that your servers are backed up here in India. So the servers where you're maintaining your accounting records are backed up here in India. So most of the global ERPs now have a local master file and backup file, which means to say, let's say you can be working with SAP or Oracle. These will get consolidated into your parent company, ka SAP, Oracle, and all of these softwares. But as far as the India file is concerned, from their perspective, they do have a backup in India to comply with the regulations. Yes.
Okay. And how can ERP integration and automation help in reducing the month-end close cycle of for subsidiaries?
Yeah. I think that's a very big thing, right? Because earlier we were looking at needing 10 days, 12 days to close. Now we're looking at 2 days, 3 days to close. And not just ERPs, I think even among the non-ERPs, there are enough and more number of tools that a lot of Indian companies like Zoho are doing in terms of how do we make this more efficient. Like I'll give you an example. It could be an ERP or one of these cloud accounting tools where provisions. Back in the day, my provisions itself would take few days to collect, because I'll have to write emails to all the business teams saying, boss, give me your provisions correctly. What are the cases where we shoot POs? I'll need to get the details to ensure that I'm providing for correctly. It would take ages, right? So now that because of ERPs, that live visibility is there with respect to how many open POs are there in the system, how many purchase requests are there in the system. So I can automatically use that as a basis for creating provisions. B, this is also relevant in cases where there are more than one entities in India, and all of these will have to get consolidated in India before it goes to the foreign entity, right? Again, ERP, and when I say ERP, I think I'm using the word ERP a little loosely here. When I say ERP, it's not necessarily the traditional ERPs. It includes any of these tech-based or cloud-based accounting tools that we are all using. They play a huge role in getting this consolidation done faster and reporting it. So I think if you're looking at a subsidiary of a foreign company, two, three areas where this whole ERP becomes very critical is, one is in consolidation with the parent entity or India level consolidation and then going to the parent entity. Second is with respect to integration of different functions. What do I mean by integration of different functions? My accounts are in one legacy tool. Payroll is in another software which the HR team maintains, right? Then my billing ke liye, there is some other tool which is integrated with CRM. So I'll take the billing details and put it here from a revenue entry perspective, right? So in an ERP, all of these get integrated seamlessly, right? So it becomes easier. And the third one, which is most important from a TP perspective, is again cost center wise cost capture and tracking, because your invoice to the parent company is directly linked to this.
Yeah. Thank you. And another one, what are disclosure requirement in financial reporting for a foreign branch setup as per Ind AS?
Foreign branch setup as per Ind AS, is it, or a foreign
Ind
subsidiary?
AS.
I'll take it as a subsidiary, because the moment you're looking at a foreign branch, then I think it's fairly straightforward, because you're an extension of foreign company operations. And the expectation is that both from a Companies Act perspective, RBI perspective, you're required to prepare a summary of your operations only for India. Right, so only for India you're required to prepare it. Now from an entity perspective, from India's perspective, again there are I think the disclosures with related party is where it will have a significant effect, right, where I'll need to very clearly in the related party disclosures talk about what are the transactions with the parent company. First, obviously I'll need to disclose the relationship with not just my parent company, with the group as well. So let's say there is a common subsidiary with whom I have dealt with. There is an intermediary holding company, ultimate parent company with whom I've had transactions with. I'll have to disclose all of the list first, the details of these parties. Then I'll have to move on to disclosing the transactions with them. And then I'll have to also disclose the balances with them, right? And from your Schedule 3 perspective, again, you'll have to very clearly disclose the dues to related parties, receivables from related parties separately.
Okay, and one more question. Will SOX will be applicable in US subsidiary setting up in India?
Right. So again, it is down to how important India is in the global materiality perspective from a SOX perspective. There are two acts that, if the moment I'm working with a US company, I would encourage all members to learn about two acts. One is SOX, which one of the learned members has mentioned. Second is FCPA, Foreign Corrupt Practices Act. These two will become applicable, not applicable from the risk assessment perspective, A. But B, if my parent company out in the US is listed, then by default SOX is applicable, which means to say that the onus is on my parent company to ensure that there are adequate controls in India in the Indian subsidiary, and there is a report that is generated here, and as members we can play a very good role in that in terms of control testing, give that report out, and then that parent company uses that report for their SEC reporting. So they'll have to do their SEC reporting in terms of the global CFO certifications, etc. And that's where this report becomes part of. That is as far as SOX is concerned. So listed company, yes. Unlisted company in the US, then again depends on their overall risk assessment, how big India is. Second part is with respect to FCPA. So in US, you also have something called as Foreign Corrupt Practices Act, where there are certain things which are perceived to be falling under Foreign Corrupt Practices Act. I think members would recall there are a few instances of, I think in the past when there was Walmart and Bharti JV that has happened, it created a huge issue because there were certain payments which is made. And so recently also we've had some companies where payments which were made, which were reported by the parent entity or the partner entity in the US under FCPA. So again, it becomes important to get a good knowledge of FCPA to see how what I need to report to my parent company so that they will have to disclose in their financials.
And one more question. Is this a good time to start an import-export business with China? And what are the rules applicable for China companies in a nutshell?
Oh, rules applicable to Chinese companies in a nutshell, very rapidly evolving. So the answer I give today may not be relevant after our Prime Minister visits China a few days down the line, because 6 months ago we had a different approach towards China with all the tariff debate with Trump now. I think now we are going to have a different approach towards China, where we're going to have a very, I would not say very liberalized, but a more liberalized import regime than what we had earlier as far as Chinese products are concerned. Now, as far as the question on export import business is concerned, see, investment, there are restrictions, right? But as far as export import is concerned, even with countries with whom we have land border, it is allowed. But what we'll have to be careful of is the duty structure, right? So the moment I'm importing from China, what are the duty structures that is applicable? So obviously there is also a higher duty structure that is imposed on Chinese products, which, like I said, for all you know, after our prime minister's visit there, things could change.
Okay, and one question that I think everyone have is that what are the ongoing compliance cost for a typical subsidiary?
Yeah. Okay. So ongoing compliance cost for a typical subsidy, all of us are CAs, we'll know. We can't give out a standard rate card, right? It depends on the scale, the volume, our scope, multiple other factors, right? But typically, I think it is important for us to communicate to the client very clearly, depending upon what is their size, what are their operations. So let's say if I am looking at a company which has about 20 to 30, a small development center or shared support center created by a foreign company in India. We are looking at close to, in addition to their finance team, which is in-house, I think just generally on compliance and all of that, we're looking at a cost of about 3 to 4 lakhs per annum in terms of your the regular compliances that is involved. This is for a small team of about 20-30. Again, based on business, this will change. Based on number of employees, this will change. If it's an SEZ registered entity, then you'll have other SEZ filings and all that will come and that will change, right? All of this is different. So if you take out the audit and the test which are performed by members who are independent, if you take that out, just for the ongoing compliance for a 20-member India subsidiary, you're looking at about 3 lakhs maybe. Yeah. But like I said, yeah, there's no standard rate card for that.
Can one last question? Can model or structure after incorporation, like
Yeah.
flipping and reverse flipping?
Oh yeah, I think reverse flip is a very big thing in the last few years. I think members might have seen some cases, let's say companies like Pine Labs and all of that. What they have done is back in the day, the structures were flipped in a manner where there's a foreign parent company and there's an Indian subsidiary. Foreign parent company would be where the IP is licensed, or IP would be housed and licensed to different parts of the world. And foreign parent is where the investment is also raised. So that would be a typically a Mauritius or a Singapore entity. But what we are seeing is with the changes that we've seen in the last 10 years, with the success of some of the listings, and I say this is, I mean, Paytm, post pre Paytm, both put together, we've still had some decent listing of startups in the Indian market, which has not been the case in a lot of countries. For example, in the US also, we've had examples of companies like WeWork struggling to get listed, right? Whereas in the Indian market, we are more receptive to sort of getting startups listed, etc. So now the entire thought process of some of these companies which are venture funded till now are looking at IPO in future has changed. Now what they're looking at is, why do I need my holding company outside India? So reverse flip would mean I will change the structure where now India itself will go to market and India will be the holding company in itself. Right? That's called a reverse flip. So we can change even let's say before IPO or a few years into India, you figure out that I need to change from being a development center to now I need to start my sales in India. Yes, all of this can be changed. But like I said, it is important to spend those initial few weeks in understanding the broad plan of the business as far as India is concerned, and accordingly suggest a structure which will give them that scale and flexibility in future.
Okay, thank you. That's all on Q&A part. And participants, today's session has taken us through the complete life cycle of setting up and running a foreign subsidiary in India, from choosing the right form of organization and aligning it with the right business model, to navigate FDI norms, incorporation procedure, RBA and Forex compliance, GST and trade facilitation, ongoing statutory requirements, and financial reporting alignment. What becomes clear is that entering the Indian market is not just a legal formality, it's strategic exercise. The right structure, compliant process, and forward looking tax and regulatory planning can make the difference between a smooth, scalable operations and a costly complex. As chartered accountants, we play a vital role in guiding business through this journey, ensuring compliance, optimizing structure, and enabling growth in one of the fastest growing economy in the world. Chartered accounts are not just compliance enablers, we are strategic partners in helping foreign business set up and thrive in India. From entity structuring a FDI compliance tax optimization. On behalf of the ICI Global Udan Initiative, I extend my heartfelt thanks to our distinguished speaker, Mr. C.A. Prashant Pelanki, for sharing his deep insights, practical experiences, and actionable guidance with us today. Your session has provided immense clarity on a subject that is both complex and critical for global business expansion. I also thank all participants for your active presence and engagement. Let us take these learning back to our professional work so we can better support business looking to make India their next growth destination. Thank you once again, and we look forward to meeting you in our upcoming sessions under the Global Udan series. Thank you. Yeah.